This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 329 was recorded on June 23, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. 42 Macro founder Darius Dale returns as this week's feature interview guest. Darius says a U.S. recession is the bull case and that the worst is yet to come for markets. And he brought a 135-page slide deck full of data-rich graphs and charts to back up that view. We'll discuss what's ahead for inflation, commodities, stocks, and much more. Then be sure to stay tuned for our post-game segment after the feature interview when Patrick's chart deck will be titled Dead Cat Bounce.
And I'm Patrick Ceresna. Now, Eric, let's jump into that S&P 500. It's flat on the day. But what an ugly week it was last week, and it really has just been the market taking a little bit of breather. I want to talk about it in the post-game, but what's your take on this?
Well, we're bouncing here. I guess we'll save for the postgame, whether it's dead cat or otherwise. But the bounce that I see is within the pattern still of an orderly sell-off into quantitative tightening and an expiring Fed put. So I think that there's still lower numbers to come, with the caveat that my view is 100% dependent on my outlook for persistent inflation. If inflation somehow magically comes under control and I got that call wrong, markets will recover and they'll recover quickly. I say a recession is coming. Watch out. That's the bearish case. Darius says, no, dude, a recession, that's the bull case, and it could get a whole lot worse. So more on that in the feature interview.
All right, well, let's move on to that dollar index because while it certainly has been consolidating for a week or two, there hasn't been any heavy selling in the dollar. It just really feels like it's just stuck in here. And even the U.S. dollar yen this week broke to a higher high. What's your take on the dollar here?
Well, we're holding 104 on the Dixie, so the uptrend is still intact. Okay, it's not really a breakout in the sense of rushing off to new all-time highs. But look, that's a 5-year resistance level that we're fighting. That's significant resistance. As I've said before, I was surprised that we started to break through it this soon. I thought it was going to take longer than that before we eventually saw an upside breakout. So I think we're actually doing better than expected in terms of a bullish view on the dollar. Now, stepping back to the much longer-term big picture for the dollar's long-term future, a few interesting events have happened recently. First, Sergei Glazyev, the economic advisor to Vladimir Putin, laid out his monetary architecture in an April interview with Pepe Escobar. That interview is linked in your Research Roundup email, and I highly encourage you to read it. Now Vladimir Putin is giving the same messaging, or I should say the executive summary of Sergei Glazyev's much more detailed message. Now, everything that Sergei Glazyev laid out was predicted in my book 4 years ago. In fact, Chapter 15 of my book is dedicated entirely to Sergei Glazyev's de-dollarization strategy, and my prediction was that he would eventually announce the intention to develop a sovereign digital currency, a global reserve digital currency, which would be backed by natural resources and sponsored by some combination of nations other than the United States. All of those predictions just came true. And a reminder, the book is still available at macrovoices.com/BB for Beyond Blockchain. It's available for purchase, and for those of you who are too cheap to purchase it, yes, there's a free download link to get the PDF version completely free of charge. So the book is as relevant today as it was then, and it anticipated all of the events that are happening right now. This is important stuff. Nobody in the West is paying attention to it. These guys are doing exactly what I predicted they would do, which is to architect a new global reserve currency system using digital currency technology. It's all happening exactly to plan, and everybody in the West is asleep.
All right, Eric, let's move on to crude oil because boy, was that a crazy week so far. Like we were always highlighting the idea that there was inevitably going to be some sort of a profit-taking cycle, but it seems when it comes, the intensity is surprising. What's your take on how things played out and how did inventory numbers influence that?
Well, there was no EIA inventory this week. They announced that there was some kind of system glitch. They've got problems. They're unable to do inventory. And I can't remember ever a situation where EIA announced we don't have the ability to deliver inventory because of a screw up and we're not sure when we're going to be able to. In the past, it was always, it's going to be delayed for a few hours or it's going to be delayed till tomorrow or whatever. So I guess hopefully next week we'll get an inventory number. As far as what's happening in the market, $22 peak to trough from the peak on the 14th of June down to Monday or Tuesday morning's low. That is really confounding a lot of people. I've read several research notes from a number of the bigger banks, and it seems like everybody's kind of confused. They're pulling out all of the standard excuses, like, oh, well, it must be increasing recession risks. Well, wait a minute. We're in the middle of a bounce on the stock market. That doesn't really add up. That doesn't make sense. So what's driving this? Well, I think one of the catalysts was a Tuesday New York Times article, that's also linked in your Research Roundup email, that described how China and India have agreed to buy enough Russian crude to make up for Western purchases. Now, that was easy to see coming. Anas Al-Haji explained a lot of this in last week's feature interview. So what are the outcomes of those crippling sanctions? Number one, Russia's oil revenue is up substantially since the war began, thanks to Western sanctions having the exact opposite effect of those intended. Again, it was easy to see this coming. President Biden and European leaders have been fools. They didn't think this through, given the fungibility of oil and Russia's ability to sell it to people who were not going to respect the sanctions, and that just means that those people are not going to be buying from Saudi Arabia, and Europe and the U.S. have to buy more from Saudi Arabia, just as Anas Al-Haji explained last week. Number two, China, anything but a U.S. ally, just got a huge discount on Russian crude courtesy of Biden's sanctions. Meanwhile, American and European consumers, number three, are paying much higher prices at the pump. Now, the knock-on effect that nobody else is talking about, so you heard it first here on MacroVoices, Russia is now in a much stronger economic condition than they were at the beginning of this war, thanks to Western sanctions backfiring. I predict that this will embolden Russia to do what? Wait for it. To play hardball with Europe come fall heating season when there is no alternative to Russian gas. Gas is much more constrained than oil. You can't just sell it to China and India because you don't have the pipelines needed to deliver it there. So an economically constrained Russia wouldn't have been able to negotiate aggressively with Europe when this all comes to a head, when the weather starts to turn cold. But now they've got plenty of money because, thanks to backfiring sanctions, they've got more oil revenue than they did when the war began. Putin is playing this chess game brilliantly, making a complete fool of President Biden, whose crippling sanctions aren't crippling anyone but American and European consumers. This is not Vladimir Putin's price hike. This is Joe Biden's price hike. The realization that Western sanctions haven't really taken much Russian oil off the market has probably been one of the catalysts for the big price decline this week, because the market is figuring out, wait a minute, these sanctions are not having the intended effect. They're having the opposite effect. That oil is still on the market. So all of that speculation that pushed prices higher, that there wasn't going to be the supply of Russian oil, no, there's still a supply of Russian oil. It's just going to India and China. So I'm still super bullish on oil prices over the next several years, but the coming recession hasn't even been priced into the market yet, and it could easily spell another $10 of downside from here in the short term. So I don't know. I'm kind of surprised by how much downside we've seen this week. There still could be quite a bit more downside coming as we eventually price in a U.S. recession. But ultimately, in the longer term, I'm convinced that we go to much higher prices.
All right, Eric, let's move on to gold because, well, really, it's been a month and gold is pretty much trading at the exact same price it was trading a month ago. And we just are watching a grind going on here. And obviously, correlation to the dollar and interest rates and all these other things are a drag on this. But do you think there's more downside from here? What's your take on gold?
Yeah, gold bug. It's so disappointing to see gold not really doing what we hoped it would do here. When Biden figures out that he's been played and humiliated by Putin, who's laughing all the way to the bank with increased oil revenues thanks to Biden's backfiring sanctions, Biden will probably do the stupidest thing possible and threaten military escalation against Russia and maybe even against China. Now, that could be a catalyst for a big upside panic move in gold if it happens. So watch for that. As far as where gold goes independent of geopolitical risks, I think that we've got much further down to go in the stock market. And just as happened in 2008, even though you can make a very strong argument for the fundamentals ought to be really positive here, in a market crash, everybody sells what they have to, not what they want to. And I think there's plenty of room for gold, and particularly for gold mining shares, to get dragged down with the rest of the stock market. Darius Dale has some great charts and graphs showing real yields, which have a lot to do with the short-term price of gold. So that should give us some insight as well in today's feature interview.
All right, well, let's wrap this with just touching on that 10-year Treasury yield because after a very explosive move on the CPI, overall, the yield has been backfilling. I mean, we're almost back to 3% after hitting close to 350. Do you think that was just a short-term blow-off top in yields, or is this just going to be a situation where this is going to hit a short-term low and then continue higher?
Well, that's the question, obviously. As far as the answer, I was going to ask you. You're the technical analysis guru in the house here. We came back down to 3%. We're almost 3%. What are we, 3.03 as we're speaking right now? That seems like a refreshing message that it didn't run away and go to 4%. But hang on, Patrick. You know better than I do that in technical analysis, a very, very common pattern when anything moves beyond a resistance level, such as the 10-year yield moving beyond 3% up to almost 3.5%, is oftentimes it'll come back down and retest what was previously a resistance level as a support level. So I think there's a very good possibility that what's happening is we're coming back down to 3%. We're going to test that, and it's really a question of what happens next. If we go below 3% and stay there, well, that says it was a blow-off top. Maybe we're headed much lower in yields from here. But I think there's a good chance that this was just retesting the other side of that 3% line. And the final tell on that, of course, is whether or not we move above 3.5% in coming weeks. So if we get below 3% and stay below 3% and keep moving lower, that's one message. If we go above 3.5%, get a daily close above that level, or even better, a weekly close above 3.5%, that's really confirmation that inflation and increasing yields are here and here to stay. I don't have any idea what the answer is going to be, but I'm watching the tape closely.
Right. I mean, at this stage, whenever a move like that happens, it is often that the moves retrace and backfill a little bit, and you're bang on that 3% levels right at a key technical level of a retracement zone. It'll be really interesting to see whether the yield holds that level. Anyway, let's move on. This week's feature interview guest is 42 Macro founder Darius Dale. Eric, why did we invite Darius back onto the show this week?
Well, Patrick, the last time we had Darius on was the 13th of January. That was about a week after the S&P had hit yet another all-time high. Everybody was super bullish. Darius was the guy to come on the show in early January and say, this is a top. I think a crash is coming. And he actually used the word crash. So what I really wanted to find out is, okay, we've been 20% down, but I don't think we've had any kind of a crash. I think we've had a very orderly sell-off, even if a big sell-off. So is the crash Darius was talking about, did that already happen, or is it still yet to come? Let's find out.
Well, Eric's interview with Darius is coming up as Macro Voices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is 42 Macro founder Darius Dale. Darius prepared a terrific and very extensive slide deck to accompany today's interview. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Look for the red button above Darius's picture that says looking for the downloads. Darius, the last time that we had you on Macro Voices was January 13th of 2022. The S&P was at 4,700 or so, just a little bit off of its all-time highs. Everybody was just singing the Goldilocks story of how everything was great. You actually used the word crash to describe what you thought might be coming for the stock market in 2022. I think you're the only guest in that time frame that we've had who used that word. So the biggest question on my mind is, okay, you definitely get some credit for seeing that something was coming. But, I think that what we've seen so far has been a very big sell-off, but frankly, it's been pretty orderly. So is the crash that you were expecting, did that already happen with the big sell-off that we've seen? Or is the crash yet to come? And if so, how bad could it get?
Hey, Eric, man, thanks for having me back on. And I really appreciate the very kind introduction. I don't consider myself, there's others making crash calls back then, but I believe we came to that conclusion through a variety of very rigorous and repeatable quantitative processes. And so I'd love to unpack them in terms of what they're seeing today, because obviously, you either made money on the crash call or you didn't at this point.
Okay, so you think the crash is over then?
No, absolutely not. I think we're sort of, let's call it inning 5 to 6 maybe in terms of the market cycle downturn, in terms of the market pricing in what we think are simultaneous slowdowns in the liquidity cycle, growth cycle, and profit cycle. I think, and we can unpack these things in either order, but I think we're probably somewhere between inning 4 and inning 5 in the liquidity cycle downturn. I think we're somewhere similarly in inning 4 to 5 of the growth cycle downturn with a significant slowdown ahead of us still. And we're likely, somewhere between inning 1 and 2 of the profit cycle downturn. And I think the earnings recession is not something that should be discounted by the average investor in terms of materializing over the next several quarters.
Well, Darius, on that note, let's go ahead and cover those 3 cycles that you just described, the liquidity cycle, the growth cycle, and the profit cycle. And because I got an advance copy of your deck, I know you've also got the inflation cycle. So let's cover that one too. That's 4 different cycles that we need to get into. Listeners, you're going to find that Darius's slide decks are extremely detailed. We're not going to have time for all of the slides, so I'm going to suggest, Darius, that we jump forward all the way to page 71 in your slide deck. Listeners, I still encourage you to peruse the entire deck at your leisure, but let's get into the liquidity cycle, which starts on page 71.
Yeah, absolutely. So just as a quick background of these presentations, we put together this what we call our macro scouting report at the beginning of every month. It's effectively trying to help investors contextualize where they are in each of those 4 cycles with a specific eye towards asset allocation and portfolio construction. We're very specific about the recommendations that we make in terms of the risk management side of things. We sort of came up cutting my teeth through that lens as opposed to sort of your traditional macroeconomist lens, so with pontifications. But anyway, so let's just hop right into, let's start with the liquidity cycle because I think that's what's driving the boat here. If you look at slide 71, I think this is a chart we're all familiar with at this point in time, if only because Jay Powell continues to harp on it every other FOMC press conference, which is the ratio between sort of JOLTS, total job openings relative to total number of unemployed. We're obviously well off, the top of the chart. And so this is the number one thing I think the Fed is focused on in conjunction with on slide 73. You look at the sort of acceleration in wage growth, particularly as denoted by the employment cost index. That's at an all-time high on a year-over-year rate of change basis, with the quits rate in the JOLTS time series in that data set, kind of coming off an all-time high. It's telling you that this is as tight as a labor market, at least as it relates to these data sets, as we've ever seen. And that's very clearly got the Fed very much engaged in withdrawing liquidity. This is something we can see on slide 75, whether you look at the pricing of Fed funds rate expectations breaking out to new highs recently on the back of that hawkish inflation print, on the back of Powell's sort of confirmation of that on the other side of the hawkish inflation print. Whether you look at 1 year forward OIS, 2 year forward OIS, these are overnight index swap spreads relative to the Fed funds rate. We're clearly on a war path to sort of tighten financial conditions from that perspective. And then when you sort of look at it from a net liquidity perspective, because I think that's equally as important if you think about the shape and composition of the Fed's balance sheet relative to things like the Treasury General Account balance, we think net liquidity is poised to decline meaningfully over the medium term. And part of the reason for that, if you can look at slide 77, part of the reason that liquidity is poised to decline meaningfully over the medium term are twofold. One, we're very much likely to see a continued acceleration in the reserve repo balance, which effectively drains money out of the overall economy and into sort of a black hole, if you will, on the Fed's balance sheet. And part of the reason we're going to continue to see an aggressive repricing higher in RRP balances is the fact that the Fed is the Treasury Department is overcapitalized from the perspective of just overcapitalized from the perspective of tax receipts. And that overcapitalization, in conjunction with Yellen's own desire to combat inflation, if you look at slide 78, has led to a pretty aggressive shortage of T-bills. And we can observe this shortage of T-bills looking at the spread between T-bill yields and similar maturity OIS. That negative spread denotes that the market is very much starved of T-bills, and therefore T-bill prices are very elevated relative to where they would be on a like-for-like basis. And so this brings me to my sort of last couple of slides, which I think are really important to take some time and explain. When you sort of aggregate all the different dynamics that are sort of influencing net liquidity, if you look at slide 79, whether it be the Fed's balance sheet, the change in the Treasury General Account balance, and the change in the reverse repo balance, it's very likely that between June 1st and December 31st of this year, we see $915 billion or somewhere thereabouts drained from the financial sector between now and the end of the year. Why is that number significant? Well, the number is significant because that's greater than the entire sum of the quantitative tightening experience we observed from 2017 through 2019, which occurred over a span of 21 months. We're trying to drain even more liquidity out of the financial sector in a third of the time. And so to me, I think that if you look at it on a fair value basis, just in terms of how our net liquidity analysis is stacking up, it's suggestive that the fair value for the S&P at the end of that process, or on December 31st, is somewhere around 2,900. Now, do I think we're going to get there? Probably not. And that's what slide 80 suggests, which is if you look at our forecast for core PCE, particularly on a 3-month annualized basis, we start to break down below 3%, which I think would, just given how much damage we've done to the economy and financial markets already, I think that would represent some form of clear and convincing evidence for Powell to sort of take his foot off the brake. We start to break down below 3% somewhere in September. That data will be reported in late October. And by November 2nd Fed meeting, you're probably going to start to see them ease up a bit from tightening financial conditions. But between now and then, we're going to have a very bumpy ride lower, as indicated by slide 79.
Now, a lot of experts are saying that the Fed's hands are tied here. In other words, people who believe in the so-called Fed put are being told, well, be careful, the Fed doesn't really have the option because of the need to fight inflation. They don't really have the ability to save the market or rescue the market. But it sounds like you're saying they really do.
Yeah, they can if look, inflation has to behave, right? And that's the beauty of doing forecasts, and also the pain of doing forecasts is, there's always forecast error when you think about the world on an ex-ante basis. And so, the size of those blue bars on slide 80 could all just be higher, just given the structural inflation dynamics we're observing in the economy. And if you jump ahead to slide 113, where we show what the bear case is, and again, this was the bear case, in our opinion, before we got the May inflation data. And the reality is we're actually getting a lot of our bear case signals starting to confirm, which is we're seeing a deepening and broadening of inflation pressure, as evidenced by, you look at something like median CPI, which is the median inflation rate of everything in the CPI basket, accelerating to an all-time high on both a year-over-year and 3-month annualized basis. You look at sticky CPI, accelerating to 30 plus year highs on a 3-month annualized and year-over-year basis as well. And then I think to me, the biggest dynamic that could make inflation statistics or inflation forecasts for peaking and eventual rolling of inflation by the kind of later Q3, early Q4, what would make that very wrong is if we continue to see a wrestling of the baton from goods disinflation, or what had been goods disinflation, it actually started to pick back up in May, to services inflation. Services inflation, if you look at core services, accelerating to 7.8% on a 3-month annualized basis. That's the highest print we've seen in over 30 years. If that becomes the dominant driver of inflation, it's look out above. Because we know owners equivalent rent and shelter inflation as a function of that are likely to continue higher in the coming months. And this is what we show on slide 114, which is the spread between home price appreciation as measured by the CoreLogic Case-Shiller Index relative to owners equivalent rent. Historically, peaks in this spread have presaged 12 to 18 month massive accelerations in OER. And this is a couple of reasons why that is the case. One, it's fundamental. You price people out of the housing markets, people have to start the rent, and obviously you inflated rental demand relative to supply, creates higher prices. But secondarily, there's a technical factor as well. The BLS measures OER in sort of biannual panels, which slows down its sort of sensitivity to lag. It really lags its changes to changes in the overall housing market. So we have a lot of accumulated inflation to occur in reported inflation statistics through this services sector lens. And in our opinion, if that really starts to wrestle the baton from goods inflation, we're going to see an even further deepening and broadening of inflation and an even further acceleration in sticky inflation pressures, which means, going back to answer your question, Eric, we may not be able to pause or pivot by November 2nd. That's just the earliest our model is suggesting the Fed can pivot. And obviously it's mid to late June, so that's a problem.
Darius, I'd like to ask you about my own views on inflation because you're much more data-driven than I am. I'm more of a thematic thinker, and I just listened to the last presser with Powell, and the thing that really jumped off the page for me was when Powell said, look, the reason that the rest of the world cares primarily about headline inflation, the actual cost of goods and services to consumers, but the reason that the Fed only focuses on core inflation, that's ex food and energy, is because the tools that are available to the Fed don't work on food and energy. And I just thought to myself, holy crap, the perfect storm that I see brewing here is an energy and food crisis beginning this summer, where we've already got energy prices running out of control. I predict that's going to get worse. And a lot of people are predicting a coming global food crisis because of the Russia-Ukraine war. Russia and Ukraine are where a lot of the potash that's used to produce fertilizers for the whole world comes from. They're expecting there's not going to be enough fertilizer to fertilize crops. There's not going to be enough food to feed people. And we're going to have massive, massive price inflation in food and energy. The very thing that Jay Powell just admitted the Fed has absolutely no control over. That sounds to me like the recipe for a situation where the Fed is going to have to go all hands on deck to fight inflation at all costs. And that potentially, I would think, could spell an outright crash in equity markets. Am I missing anything there?
No, you're not, my friend. I mean, so obviously this could get a lot worse, right?
Well, that's not good. I was really hoping that you would pull out go to slide 423 in my deck, and I'll show you why you're wrong. Help me out here.
So let me start by saying that it is already getting worse. If you look at food inflation, food CPI on a 3-month annualized basis at 12.2%, that's the fastest rate we've seen in 42 years to be exact. And energy inflation, look at it on a year-over-year rate of change basis at 35%. That's the fastest we've seen since September 2005. So we already know that this is already a problem. If it gets worse, according to all the factors that you just highlighted, it's going to be a secondary impulse on inflation relative to what I believe will be the primary impulse on inflation over the summer, which are services inflation. But I think more importantly, one thing we have to watch out for, at least with respect to crude oil demand and energy demand specifically, is a material slowdown in the growth cycle. We can get back to the inflation cycle later in the interview, but I do believe it's important to contextualize the magnitude of the deceleration in growth we're walking into, really starting in the early part of the third quarter that should persist really into the early part of next year. So if we don't mind, I think it's important to transition to growth cycle, and then we can go back to the energy cycle from there. If that's cool.
That's cool. Let's go back to slide 81 there. I think that's the beginning of where you talk about the growth cycle. Give us the story on growth.
Yeah, absolutely. So on slide 81, in the top panel, we show real 10-year yields. So the 10-year nominal treasury yield as deflated by the Cleveland Fed's 10-year forward inflation expectation. This allows us to create the longest time series for 10-year yields on an ex-ante basis, not looking at lagged CPI. And historically, whenever you've seen sort of 2 sigma delta breakouts in this yield on a trailing 3-year basis, all hell breaks loose in the economy, for lack of a better word. You've seen very significant slowdowns in something like the ISM manufacturing PMI as a proxy for growth in the economy, as denoted by those dotted black lines. On slide 82, it's the same analysis. We just show it looking at corporate borrowing costs, as denoted by the Bloomberg Barclays aggregate credit index yield to worst. And every single time we've seen a 2 sigma breakout in that, we've always seen a significant slowdown in growth. And as you can see, this is one of the worst we've seen on record going back to date. There's a 3 sigma breakout in corporate borrowing costs on a trailing 3-year basis. And then lastly, this shocking, for lack of a better term, biggest shock in mortgage rates we've ever seen in the time series. And again, it only goes back to 98 in terms of nationwide mortgage rates. But, at least in this 20 plus year time series, this is by far the biggest shock on a trailing 3-year Z-score basis at 3.2, 3.3 sigma. And so historically, we've always seen a pretty significant slowdown in the PMIs, et cetera, as a function of that. So we already know the forward guidance that the Fed has instituted into the market, into this tightening cycle, in conjunction with the actual tightening they're doing, obviously with rate policy rates in the balance sheet, is already accumulated a lot of slowing that we're likely to have ahead of us in the coming 2 to 3 quarters. The next slide shows energy crises. We're obviously very much in an energy crisis, and how we define that is a doubling of energy prices, of doubling of crude oil prices on a trailing 2-year basis. We got data going back to the early 70s, and we've seen, let's call it 7, 8 energy crises, and they always tend to cause big problems in the economy where, most are marked by recession and significant drawdowns in the equity market. Some are only marked by significant drawdowns in the equity market if you look at something like 2018. But, there's really only one out of this entire in size, which is 2005, where we had an energy crisis and we didn't see a significant slowing or recession in the economy and or crash in the stock market. And so to me, I think the just from a probability standpoint, the world is the spectrum of catalysts is very much stacked against anything but a significant slowdown in growth. And this is why, when we get to slide 85, we talked about this, we've been talking about this for a while now, which is a soft landing is extremely unlikely just given the starting point, right? Like we were effectively starting a tightening cycle at a gainfully and fully employed economy. If you look at the level of the unemployment rate relative to the onset of the Fed's tightening cycle, it's the lowest it's ever been. And so obviously the Fed has a very poor track record in history. I want to say, 11 of the last 14 tightening cycles have ended in recession. So that's already that was already working against them to begin with. But, this 15th one here of the last 15 is starting from a much lower level of unemployment rate, much higher level of total employment. And so in our opinion, the likelihood of a soft landing was always very low. And this to me is the biggest issue with respect to everything I've just said for the last few minutes, which is on slide 86, growth estimates. The red line just shows the consensus, Bloomberg consensus, Wall Street economists, folks who sit in seats like mine, what their expectation for real GDP growth is for 2022. And it's come down. It was peaked to somewhere around, let's call it 3.5%, 4%, but it's now down at 2.6%, which is still 20 basis points faster than our trend growth rate from 2015 to 2019. I don't know the quality of drugs these folks are smoking, but it's to me, this is the most ridiculous slide in the deck. We are not going to grow above trend in 2022. And that, in my opinion, is if we have a variant perception right now, we're not going to grow above trend by the end of the year. And we're very much likely to head into something that may resemble an earnings recession, if not an outright recession.
Darius, I want to talk a little more about what you just said about recessions and what's coming and so forth, because exactly as you said, I think it's very clear that we are headed toward recession. But frankly, even if I'm wrong about that, I think that the Fed although they will never admit to it, needs a recession in order to fight inflation. So even if miraculously you and I both got this wrong and growth expectations that you're showing on this chart turn out to be accurate, and that's really where the economy is headed, I think that if that happens, it means inflation runs out of control and the Fed has to work harder to fight inflation until they eventually do induce a recession. You're much more data-driven. That sounds good in my head, but I can't prove it. Can you?
Yeah, so so I think we're arriving at a lot of the same conclusions, Eric. So I think you're giving yourself enough credit for being a data-driven geek like myself. But I'll start by saying, what the Fed.
Well, I give myself more credit. I make this shit up without the data. So if I'm getting it right,
Fair enough. Well, the jury's still out. We're speaking ex ante here. So, but I do agree with you that the only way to get a significant reduction in price appreciation in general price level of the economy is a significant reduction in demand. Because clearly the supply side of the equation is not going to come back anytime soon. Whether you look at the decline in energy reserves, or decline in, or the I don't even know what word to use in terms of what's going on with the agricultural supply in the mix globally. And then obviously we have a reduction in labor supply, which I think we have that on slide 72. But what I really, I think the channel that the Fed is likely to try to work through is again a reduction in corporate profitability that ultimately slows down demand for labor, slows down the corporate's ability and willingness to pass on price increases, and ultimately to pass on wages. And we can kind of see this if you look at slide 87. Corporate profitability is very cyclically elevated right now. At the top panel, we showed the S&P 500's operating margin at 16%. That's basically 200 basis points higher than it's ever peaked at. And so this is telling you that corporations are feeling very, very fine and dandy about passing on the very aggressive rise in unit labor costs, which is the middle panel in this chart, on to consumers, right? They're saying, well, we're seeing this unit labor cost inflation 40-year high in that metric, so let's just pass it on to consumers. And we can obviously observe this on slide 88. The red line just shows corporate profits as a percent of GDP. Those are structurally elevated as well. So you have corporate profitability cyclically elevated and structurally elevated because of this animal spirit mindset that we can just push through price and hire whoever we want and pay them whatever we want. But ultimately, I think that in the conjunction with our views on the growth cycle, that expectation is likely to be proven invalid in the coming quarters. Part of the reason I believe that is if you look at the inventory cycle on slide 89, basically 4/5 of our growth, of our headline GDP growth in the last few quarters has come from inventory build. That's not a good sign in terms of the likely ability of corporations to pass through these prices. And so ultimately on slide 90, we're taking the view that earnings estimates, much like consensus growth estimates, remain out to lunch. And if the longs are out to lunch, that's a headwind for the market. Now, if they correct and get in line with some reasonable expectations, then that would be okay. But they're not in line with reasonable expectations. And the last thing I'll say on this is jump ahead to slide 118, where we show corporate profitability on a trailing 12-month basis. And historically, you've seen these drawdowns in corporate profitability, and I should measure that as a breakdown below the trailing 3-year mean. Whenever we've seen these breakdowns, you've typically coincided with recessions, because obviously you think about the sort of microeconomic standpoint, which is corporations, they get scared, they don't pass on costs, they don't hire, they don't push through wages, and that overall reduces the level of demand in the broader economy and slows inflation, but also crushes growth in the process. And so to answer your question in a very long-winded manner, the Fed needs a recession or something that looks like a recession to get inflation down.
Now, the topic of corporate profits that you've just described has gotten the attention of the Biden administration. So I'd like to talk now about what policy interventions might be coming and whether or not they would be effective. I'm guessing that you and I could probably agree that price controls have historically not worked very well, but that's not going to stop politicians from implementing them. And already we've seen President Biden literally threatening the oil industry, saying, look, the profit margins on refining are just too high. We've got gasoline prices which are higher on an adjusted basis based on the price of crude oil. We've had crude oil just as expensive as it is right now before, but gasoline prices were not this high. Refining costs are the problem. Of course, the Biden administration does not acknowledge that their own policies have resulted in a decline in refining capacity in the United States, which is unlikely to ever be reversed. But, that's not going to come into the policy discussion. So I think, Darius, we could be headed toward price controls in some markets and other strong efforts on a policy front to try to reduce those corporate profits in the name of protecting the U.S. consumer. That sounds good, but what could go wrong?
Well, I'll start by saying it does not sound good if you're long risk. Price controls are incredibly bearish for obvious reasons, but also for unobvious reasons, right? All you're really doing is taking some short-term gain for the guaranteed long-term pain. That's what price controls are, because ultimately what they do is they further push the supply curve inward, right? You're disincentivizing risk takers, capital allocators, to create new supply in various industries whenever you slap on price controls. So I happen to have a view that it's going to be very difficult to push through anything of substance from a political standpoint. And part of the reason for this goes back to our discussion from over a year ago now, Eric, the summer of 2001, when I said, hey, look, the U.S. is something like an emerging market from the perspective of political risk. We have on slides 67 through 70 what we call our four horsemen of economic risk. These are the kinds of things that you need to understand in order to effectively price risk, price rates, price currencies, price valuation on a relative basis across geographies, demographics, leverage, politics, and balance of payments. And if you look at slide 69, politics, where we show, something like the Gini coefficient. On the x-axis is a proxy for, income inequality in the country. And on the y-axis, we show the prime working age employment to population ratio. You look at where the location of our dot is on the U.S. relative to, the surrounding dots. I mean, these are emerging market economies. These are not Western societies, Japan, et cetera, Europe, where there's a lot more harmony, a lot less inequality and political dissension. No, this is what's fueling the zeitgeist of piss offness, for lack of a better term. And in my opinion, I think this sort of zeitgeist has always been there. It's underlying a lot of the stress we're seeing in the political system, which ultimately tells me that into a midterm election cycle, we're not going to see anything of substance. Congress is out to lunch and has been out to lunch, partially as a function of this, but in my opinion, going back to the call we made in early November of last year to get out of high beta risk assets, they're out to lunch because inflation is a big issue as well.
Darius, unfortunately, everything that you're telling me is just reconfirming my greatest fears, which is it sounds like we're headed toward a worse than 1970s secular stagflation, where we see continued commodity price inflation, which causes a recession. Everybody assumes that the recession is going to bring commodity prices dramatically lower, but everything we've done in terms of policy assures that they don't come any lower, that they stay high. That creates a stagflationary environment that we could potentially be stuck in for years. Now, dude, you got 138 slides on the deck. Show me the one that tells me I'm wrong. I so want to be wrong about that there's no stagflation coming and we don't have years of economic woes ahead of us.
So I'll do my best. So if you go to slide 121, where we show our secular inflation model, this is a dynamic factor model that looks at 62, sort of the independent variables on that have historically been proven to be factors in driving inflation higher and lower over the last several decades. And, when we do the math on this model and delta adjusts everything in terms of its impact on something like core PCE, we're only really getting to, on the upper end of this sort of projection, something that's about 70 basis points higher than where core PCE is trended in the prior decade. So in the prior decade from 2010 to 2019, we saw core PCE trend at 1.6%. In terms of our model, this is a secular inflation model, is suggesting that the upper boundary of that is in terms of on a trend basis is somewhere around 2.3% in this current decade. We're obviously tracking a little bit higher than that at 2.8% decade to date, but obviously we're probably going to get a recession or two in there that'll get that number down. So to push it back against your viewpoint, we're not seeing a wholesale material jump condition higher in inflation. Now, this is material from the perspective of fixed income allocation, et cetera. We're talking about on the high end a 40% phase transition higher in trend core PC inflation. That is significant from an asset allocation perspective, but I don't think it meets the sort of merits of what you're sort of talking about from a longer term secular inflation perspective. However, I do believe there's something else to be added to this, because this is all the dynamics that really influence core PC, which obviously strips out quote unquote volatile food and energy prices, whatever the hell that means. You look at slide 106. I think 106 and 107 really add support to what you're sort of saying from a longer term energy and food inflation perspective. Slide 106 just shows sort of the change, or sort of the net capital flow into or out of the U.S. economy as measured by the change in our net international investment position. And what we're seeing is this massive capital inflow in the last sort of, let's call it 4 years, particularly the last 2 years into the U.S. economy. And think about this from the perspective of what's been happening. It's been a perfect storm for everyone to park funds in the U.S., right? Like we overstimulated, not only on a historical basis relative to any stimulus we've ever done historically, but also significantly overstimulated relative to our peer economies and other economies that you could have chosen to invest in the last couple of years. And then we obviously got vaccines faster. We have, sort of a libertarian bias to our voter base. And so we were able to significantly outperform both economically and from the perspective of earnings growth in the last few years, which is why we've seen nearly $7 trillion of capital flow into U.S. assets in the last couple of years. That's not unlike the period we saw kind of in the late 90s when the whole world was blowing up. You had the Asian financial crisis, the Mexican tequila crisis, the Russian default, et cetera, created very attractive. It made the U.S. a very attractive destination for capital. And oh, by the way, we had this thing called, the development of the internet, et cetera. It's very much not unlike the development of the COVID viruses, et cetera. Well, you fast forward to where we're likely to be on the other side of the eventual dovish pivot, after we've seen enough carnage in financial markets, after we've seen enough of a growth slow down that weighs on inflation statistics and inflation expectations, we're going to be talking about a Federal Reserve that's going to go from as hawkish as anything we've seen since Volcker to quite possibly, very dovish as Yellen or Bernanke. Let's call it in the next 9 to 12 months. And on the other side of that pivot, the dollar is going to be secularly challenged as a function of all this accumulated capital flow into the U.S. economy. I mean, you're talking about a significant depreciation of the dollar, let's call it, throughout 2022 and 2023, and even beyond that, as a function of the unwind of that positioning. And that's obviously going to favor commodity prices on a secular basis. It's going to favor emerging market assets. I'm talking about slide 107 here now. It's going to favor emerging market assets in lieu of U.S. assets. It's going to favor cyclicals in lieu of defensives. It's basically the opposite trade that anyone's been forced to have on by the market or their boss in the last sort of decade plus. And so to me, to answer your question, when you look at the secular drivers of the core inflation that we have in the economy, maybe at best it's somewhere 40 to 50% higher on a trend basis. But then you look at the secular drivers of the non-core inflation, could be much, much higher over the coming decade. So I don't disagree with what you're saying.
Let's come back to my thesis of a food and energy-driven inflation crisis. And I guess, if we can get back to the 2.3 or 2.8% and 2-point-anything percent, sounds great to me. But what I see is we've already gotten this kind of runaway situation with inflation. And everybody politically wants to blame Vladimir Putin for all of it. Biden calls it the Putin price hike. And I think, well, wait a minute. Let's look at this objectively. Russia hasn't done anything to intentionally create commodity price inflation. The sanctions that the West imposed, as far as I can see, are kind of a self-inflicted inflation wound. And yeah, they did it for a reason politically that was important because of the atrocities that are occurring in Ukraine. I get it. I'm not questioning that. But the price hike was imposed, in my perception, by the Western sanctions that were levied against Russia, saying, we're not going to buy your oil anymore. Well, if we're not going to buy their oil, that's going to disrupt the oil market. The price is going to go up, and we've already seen that happen. We haven't even gotten to the point where Russia says, hey, let's take this opportunity to squeeze the West by intentionally taking action on Russia's part to push commodity prices harder and use inflation as a tool of economic warfare. Now, meanwhile, Sergei Glaziev, Russia's chief architect of economics, has laid out a new future where he describes, not that I predicted it in my book 4 years ago, not to toot my own horn too much, but he describes a digital currency system which is backed by natural resources. If Russia wants to put the squeeze on the West, my prediction is they wait until the West is done self-inflicting its own inflation wounds. And then just when the U.S. finally realizes, okay, stagflation has gotten to the point where we have to change course. We can't afford any more sanctions against Russia. We're going to lift them because we're economically given no choice. I predict that's when Russia says, oh, yeah, guess what? We don't want to sell you any oil at this point. We're pissed off. How does that fit into this whole equation?
Eric, you hit on this masterfully, and I want to just take like a step back before we get back into the deck to just make one point of this entire presentation. The whole point of this entire deck is to help investors understand that the left tail of outcomes is much wider and much fatter in shape than I think the average investor realizes. I think the average investor thinks we're a lot closer to the far left end of the distribution of probable outcomes economically and financial market wise than we believe. And we're talking about the base case being something that's pretty negative, even from this starting point. But I think you just outlined something that's even more negative than I think even our base case is at 42 macro. So a couple things, just getting back into the deck. You mentioned that, sort of there's this narrative out there that Russia has caused a lot of inflation, which I find to be preposterous. I mean, just look at slide 5. The third to last line in that table above our U.S. grid model chart just shows headline CPI, just where the trends in headline CPI have been. And in January 22, before Russia did anything to harm a single Ukrainian across any Ukraine border, headline CPI was 7.5% year over year, right? Like we're at 8.6% now. So let's say if Russia caused 100% of the incremental inflation, they've only caused 90 basis points of inflation from that perspective. And then secondarily, going back to slide 113, where we should just break down all the various major components of CPI, if you look kind of midway down through that table where we show core services inflation, stuff that Russia has nothing to do with. This is services inflation. Me getting my utility bill, me going to the theater, I don't know, getting an airplane ticket, all this stuff that Russia has very little to no negligible impact on. And again, at 5.2% year over year, that's fastest since June of 91, 7.8% 3-month annualized, which obviously means the time series continues to accelerate, is fastest since August of 1990. And so to me, I think there's the narrative that Russia is causing a lot of this inflation is a very dangerous narrative because it doesn't take into account all these other factors that are really contributing to the inflation story. And more importantly, all the other factors that are going to fall out of the inflation story, which again is a significant slowdown in growth and a potential earnings recession in the U.S. economy.
Well, Darius, I think it's really important that we stress also that, yeah, sure, to some extent, the Russia-Ukraine war has been a big driver of inflation. But the thing is, these have been self-inflicted wounds on the part of the West. The reason that we've had that inflation is because of the sanctions imposed on Russia by the West and the knock-on effects that they have. So far as I'm concerned, there hasn't been any action taken intentionally by Russia to say, let's do such and such in order to cause more inflation that's harmful to the West. But if you think about what could Russia do if they intentionally wanted to harm the West using inflation as a tool of economic warfare, well, hang on a second, Darius. We just talked about Jay Powell admitting publicly that the two things that the Fed cannot control are food and energy inflation because they don't have any tools to combat that. Russia is a big enough producer of oil and natural gas that through their own policies, through their own decision not to sell energy to the West, they can blow up the global energy price as much as they want to. And oh, by the way, the only way that we can possibly make enough food to feed all the people on this planet is to fertilize crops. And guess where most of the potash used to create the fertilizer comes from? Russia and Ukraine. It seems to me that Russia is in an incredibly powerful position to use tools of economic warfare against the West, which it hasn't even begun to use yet. Would you agree? And what does your data tell you about how bad it could get if Russia started using those tools?
So yeah, Eric, I appreciate that. I don't know if I'm the perfect person to to maybe answer the question to understand the full range of sort of probable outcomes if Russia does elect to play economic war games, maybe more than it already has. But I do think I have a good enough understanding of what the terminal downside would be if you look at something like risk assets. So, let's jump to slide 91 and 92. On slide 91, we show, looking at the Goldman Sachs Financial Index in the blue. That's the longest term time series for financial conditions index. So I like to use that one just to pull the chart back. And as you can see, we're still technically in accommodative territory, and we're well off the kind of levels of financial tightening that we've historically seen in bear markets of consequence. Obviously, 2000 to 2002 and 2007 to 2009 would be the last two bear markets of consequence. And then you look at something like the S&P 500's next 12 months earnings yield, which is the red line in this chart at only 6.07%. Again, we're well off levels from a cheapness of the market perspective that would catalyze, broad-based buying, hold your nose style buying from large-scale asset managers, pension funds, endowments, et cetera. And so it's telling you that we have a long way to go down from that perspective. Slide 92 sort of looks at this and tries to tackle this question from another angle. The red line in this chart on slide 92 just shows the ratio of high beta stocks in the S&P 500 relative to the ratio of low beta stocks. And as you can see, we've suffered a roughly 23% drawdown, peak to present drawdown in this index really since the highs we've seen late last year when we made the call to get out of high beta risk assets. Historically in these sort of growth cycle downturns, as of course we're currently in one, we've seen somewhere between a 35 to 40% decline in this high beta, low beta ratio. So it only down 23%. It's effectively saying that, hey, if we don't go into recession, we're still only probably a little bit more than halfway in terms of the market ultimately pricing in a growth cycle downturn. Obviously, if we go into recession, we're talking about something that's on the order of 50 to 60% down in this index, which means we were only somewhere, closer to half or even a third down. A few more charts I'd highlight on this. If you look at, skip ahead to slide 96, you look at the positioning of the market. And this is something that really kind of, this always gets me going because you hear all this stuff about sentiment this, sentiment that, everyone's bearish this, everyone's bearish that. But then when you actually look at the actual data, the flow of funds data, the Fed's flow of funds data, the U.S. household sector is as long stocks as it's ever been. If you look at the ratio of equity ownership to overall net worth, I mean, we're coming off an all-time high, and historically peaks in the spread, cyclical peaks in the spread have catalyzed median S&P 500 drawdowns of 22%. So that's right where we are today. So you could say from this perspective of this analysis, maybe we're fully priced in terms of the drawdown we might see, but I would argue maybe the drawdown needs to be more significant, just given the starting point of overall all-time high equity ownership. Secondarily, moving ahead on slide 97, you look at this from a business cycle standpoint, and what I'm showing here, just as a proxy for the business cycle, the cyclical components of the business cycle, we're showing the Conference Board's labor differential survey. And we're coming off an all-time high here, and historically speaking, cyclical peaks in this indicator have coincided with 35% declines on a median basis in the S&P 500. So clearly not anywhere near where we could get from the business cycle perspective. And then lastly, on 98, valuation. To me, this was always the biggest problem with asset markets, the positioning and the valuation associated with that positioning. You're looking at the blue line is the S&P 500's real earnings yield. The earnings yield as measured or is deflated by sort of realized CPI, and at minus 3.3%, we're coming off an all-time low or an all-time high richness valuation of the S&P 500 on a real basis. And so historically we've seen 6 of those inversions since going back to the early 70s, and the median drawdown is 41%. And so you're talking about right now we're down somewhere around 20% on the S&P. We're in the middle of a bear market bounce again. That is what it is. It'll resolve itself. But ultimately, you're talking about the market having another 2,000 basis points of downside, or at least 1,500 to 2,000 basis points of downside, where you look at it from the perspective of the business cycle and valuation. So to me, these risks were always there and ever present. And we've been talking about these slides and these decks for quarters now at this point to our clients at 42 Macro. But when you layer on the fact that Russia could start to really make this a lot worse from an inflation perspective, and then obviously a Fed reaction function perspective, it's telling me that these slides may in fact, the medians on these slides may in fact be too kind.
Well, let's put some hard numbers on all of this then, because I thought you said earlier in this interview that some of your projections were kind of implying that 2,900 on the S&P would be about as bad as it could get, but you didn't think it would get that bad because the Fed would intervene. I've tried to counter that with a few arguments as to why I think if Russia decides to play hardball, which I don't think they've actually done yet, I think that the Fed's hands might be tied a little bit. So is 2,900 on the S&P, is that the worst it could get, or does it actually maybe get worse than that?
Well, so again, going back to slide 79, 2,900 on the S&P would be fair value if our net liquidity analysis, which again takes into account the changes in the Fed's balance sheet from quantitative tightening, the change in the Treasury General account balance, and ultimately the projected change in the reverse repo facility balance. If we get down to the levels we have projected from a net liquidity perspective, you're talking about the red line being dragged down alongside the blue line to something that looks like around 2,900 on the S&P. And at 2,900 on the S&P from the all-time high on January 4th, that is about down 40%, right? So, I mean, I think, again, the bear case is very significant, and it's a lot fatter tailed, and there's a lot more sort of girth to the tail than I think the average investor realized, which to me is, again, the overall arching point of this presentation. It's not to come out and be bearish and scare people. It's just to help them, carefully and thoughtfully manage risk around a lot of these cyclical dynamics. Knock on wood, we've done a dang good job year to date in helping investors actually make money as opposed to lose lots of it. If you look at our portfolio construction on slide 57 and 58, which, unfortunately for this particular presentation, we have blacked out of respect and admiration for our paying clients.
Okay, Darius, so as we tie all of this together, we've talked about why you and I both think that there's probably still quite a bit of downside left to go. You're saying fifth or sixth inning or so in terms of these cycles. I'm talking about a thematic situation, which I'm concerned about, of stagflation really getting worse with an energy and food-led inflation crisis really starting to heat up over the summer and into the fall. But our job is to also think about how we could be steering people in the wrong direction. So is there anything in the data that says maybe something could happen that you and I are both wrong and the bottom's already in and it's all uphill from here for the stock market?
Yeah, so that was our, on slide 3 where we show our key takeaways, our bull case scenario was always a low probability, but it's, in my opinion, I think it's a low and declining probability now, which is, a really sharp decline in inflation inflates real incomes and perpetuates a sort of or staves off this sort of sharper growth cycle downturn and ultimately staves off a significant profit cycle downturn, or at least punts both of those dynamics well into next year. We're not getting that, obviously, in my opinion. I think we're moving in the wrong direction for that risk. And ultimately, I think what's happened since the May CPI report, that was obviously reported a couple of weeks ago, what really has happened, we've taken the probability associated with that Goldilocks scenario from, let's say, less than a third, 25%, to something that's probably close to like 10%. It's now a 10 delta call option as opposed to a 25 delta call option, in my opinion.
Well, it sounds like my thematic views and your data-driven views are very much coming to the same conclusion, because what I've been saying is I need to be proven wrong here on inflation, because what can change all of this and completely negate my bearish view would be if somehow, some way, inflation really was transitory. We're headed back down to 2%, and everything's going to be rosy from here. I think a food and energy-driven, much bigger inflation might be in the cards, but I sure hope to be proven wrong. So I think in terms of where the bull case is, it turns out both of us are wrong on inflation, and the Fed gets it all under control, and they're free to defend the market because inflation's not a problem anymore. I just don't see it going that way, but that would be the bull case. Darius, final question. As I think about the market route that we've had, a lot of people have described this as a crash. I can't help but observe, if you look at the technicals, really it's been a fairly orderly, controlled, a very significant sell-off, more than 20% on the S&P now, but it's been fairly orderly. And based on what I know about the psychology and emotion of markets, usually you have to see a panic, and the panic really drives a lot of downside, and eventually you get to a capitulation where there's a really extreme move at the end, and that's where the bottom is finally in. Now, if I apply that logic, which admittedly, that's everything I've said here is data-free. I'm just talking about how the psychology of markets usually works and how I don't think the big fear has really happened yet. It seems like it hasn't even started yet. Like we've only seen the beginning, and the part where fear and emotion comes into the equation maybe hasn't even begun yet. Is there anything to that, and is there anything that we can do with data to quantify whether or not those fears are justified?
Yeah, absolutely. So I completely agree with you. We have not seen capitulation, at least broad-based capitulation. You can look at slide 95, where we show VIX curve backwardation as measured by front month this minus the 6-month forward VIX future. And you look at the level of backwardation we sort of got to at the most recent lows. It's nowhere near the sort of peak levels of backwardation we've seen in recent market routes. Market routes that, by the way, have been substantially sharper than this in terms of the speed and realized volatility of it all. So we're not even in like knocking on the door of capitulation from that perspective. And so this is why I wanted to put together. That's why I did put together for our clients on slides 100 through 104, which look at the 5 major sort of bear markets that we've seen in the last 100 years, whether it be 1929 through 32 on slide 100, 37 through 42 on 101, 73, 74 on 102, 2000 to 2002 on 103, and 2007 to 2009. What each of these markets or bear markets has in common is a acceleration of convexity to the downside towards the later innings of the bear market. And to me, that was very interesting when I studied this. And there's a few key takeaways. One, there's a lot of bear market rallies of significance in these bear markets, very significant bear market rallies where you can get your face completely ripped off as a short seller if you time shorts very wrong. However, you always, get a chance to make money on the short side if you have the staying power to stay in the trade. So that was sort of one of the key takeaways, that negative convexity, really accelerating to the downside in the latter innings of the process was another key takeaway. And then the final key takeaway was, didn't matter the size of recession, didn't matter if it, where the recession was and the timing of the bear market. The recession was not the key catalyst. You had the bear markets, particularly whether you look at 37 and 42 or 2000 and 2002, where the trough of the market was actually after, months, if not year after the recession, and others were obviously trough during recession, et cetera. And obviously the size of these recessions are all very disparate in nature, ranging from one slide 103, minus 70 basis points peak to trough in GDP terms versus minus, 600 basis points peak to trough on slide 104. So all you need to know is that this blank can get a lot worse if you're right on a lot of those sort of left tail risk dynamics you talked about, Eric.
Well, boy, if I look at page 104, this is really striking because what this says to me, Darius, is for those people who feel like, hey, look, the bear market already happened. It's bottoming. It's time to buy the blood in the streets because we're already down 20%. Well, look, what's already happened is, in fact, a repeat of the bear market of 2007. The 2008 part hasn't happened yet.
Yeah, exactly. So we'll leave it at that. Terrifying. We'll leave it at that.
Darius, I can't thank you enough for a terrific interview. But before I let you go, I want to talk a little bit more about what you do at 42 Macro and how our listeners can find out more about it.
Yeah, so again, appreciate the opportunity, Eric. I always love connecting with you and your listeners. You do one of the most valuable services out there, free or not free. I've learned a lot from listening to the program over the years, so I'm always very grateful to contribute. What we do at 42 Macros is pretty simple. We try to help investors contextualize where you are in the cycles that matter most from the perspective of macro, which are the liquidity cycle, the growth cycle, the inflation cycle, and the profit cycle. And ultimately, we tie that back to a extremely systematic and rigorous, robust, quantitative, sort of asset allocation process that we feature on slides, 37 through 58. We ultimately tie everything we're talking about into very specific, actionable portfolio construction advice. We consult institutional investors, hedge funds, mutual funds, endowments, corporations, high net worth individuals, all the way down to retail traders, even crypto bros, and et cetera. We don't care. Everyone needs to understand where we are in these cycles in order to capitalize on changes in policy, changes in market dynamics, and ultimately changes in the P&L in their portfolios.
And this full slide deck that we're looking at, you update regularly and send out to your listeners. So all these graphs and charts, the updated versions are available to your listeners. Is that right? How often do they get them? And how are those services offered both to institutional and retail investors?
So there's a couple things, Eric. I'm glad you brought that up. I think I'm the only idiot in finance that tries to put out 100 and 150 slide page presentation every month. I don't know. It's a labor of love, but the reality is I need to do all of this work myself in order to help me set our customers up to best take advantage of financial markets. So the reality is why not just sell the information because I'm going to do the work anyway. So we put out this presentation every month. Obviously, the charts will change. The first 70 slides of the presentation don't change. That's everything we refresh. All the models we refresh on a daily basis that we write about in our morning note. We have a weekly podcast series for our clients that helps them manage portfolio risk. And ultimately, it all boils down to our views on the cycle, which are presented in these monthly presentations. So come check us out at 42 Macro. We appreciate the opportunity. The one thing I'll say I think we do differently than a lot of investors, certainly at firms I worked in the past, is everyone gets the same information from us at the same time. I don't care if you're running the $2 trillion global fixed income fund, or, we have clients that do that. And we have clients that are run a couple $1,000 of crypto money. They're all getting the same information at the exact same time. And at the end of the day, we want investors, we want everyone who's on Team 42 to succeed. So definitely come check us out.
And we'll look forward to getting you back on MacroVoices in a few months for another update. Patrick Ceresna and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail order Viagra salesmen need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Darius back on the show. It's always nice to see some quantitative data kind of backing up some of the things that we're seeing happening in the world. What did you take away from this?
Well, it's further confirmation for me that I think the worst is still yet to come. And what I'm particularly interested in is that last question I asked Darius, which is, we've already seen a pretty significant sell-off here. It's not just a correction, it's a bear market in stocks. Okay. It's been a very orderly sell-off, and I haven't seen any signs of panic and fear and all of the emotion that usually causes markets to truly crash. Is that still coming? Sounds like it is. And, a lot of people think that, surely this must be the bottom. I think this may be the end of the orderly part of this sell-off, and it could get ugly from here. So I think Darius's number of 2,900 on the S&P sounds about right to me, and I would guess that happens in October. Now, there's another interesting dimension to this, Patrick, and I guess I'm showing my age. I didn't think of this until I read some emails from some of our listeners. Think back to the housing crisis in 2007 and 2008, and how much of a reflexive effect there was from all of those people who speculated buying 3 or 4 houses expecting to flip them and make a big profit, and then the housing crash happened, and all of a sudden their hopes and dreams were shattered, and they went into panic mode, and that caused this great big accelerating effect on the bear market and gave us the 2008 crisis. Well, fast forward to today. As people my age, or even your age, Patrick, look at the crypto crash which has occurred, we kind of shrug and say, oh, yeah, well, it's back down to it got down to 17,000 something the other day. I thought it was overvalued at 17,000 something back in 2017, so doesn't really surprise me much. I knew it was going to be a bubble. I predicted that in my book. I said it had further to go to the upside, which it definitely did. Now it's back down to about where it was when my book was published, so no surprise, shrug it off, whatever. Well, hang on. For Generation Z, this event was as big, if not bigger, than the housing crisis was for Generation X. A whole lot of these Generation Zers put everything into crypto. They thought it was a magic money machine. Unfortunately, their hopes and dreams have been crushed now. A lot of them got washed out. We had a listener I mentioned last week whose restaurant had a whole bunch of servers quit because they got rich in crypto. Now they're all coming back begging for minimum wage jobs. So nobody in my age group even noticed it. But for Generation Z, we just had a financial crisis event every bit as big as the housing crisis. And it's important to understand that's going to affect buying patterns. And younger people have a big impact on the economy because they tend to do more discretionary spending than more stable older people who are my age. So there's a really important reflexive event there, and I think a lot of us old guys were missing it. So my thanks go out to our several listeners who pointed that out to me in their emails. But let's come back to what's happening in the market right now, Patrick. Is this a dead cat bounce, or are we actually recovering here? Listeners, you'll find a link to the chart deck in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, and click the red button that says Looking for the Downloads. Patrick, dead cat bounce, or is it the beginning of something bigger?
Eric, what I want to do is look on page 2 on the S&P 500, and I circled here 4 of the previous bounces we had this year, and each one of them, were anywhere from 300 to 500 S&P points in a span of a week or two. Just a very solid bounce off of a very oversold condition. Here, off of that CPI number that basically wiped out 500 points on the S&P to the downside. Here we are 3-4 days after a short-term low, and the S&P can't muster up even a half decent reaction off of that low. So far, it's a very weak reaction, and it's not just the S&P, and this is actually what the important part that I want to highlight. So let's look on page 3 where I have the NASDAQ, and you can just see that the NASDAQ continues to remain below its May lows, not able to even have any reasonable reaction off the lows. You look at the Russell 2000 small caps after breaking to a lower low, I wouldn't even call that a bounce. I mean, it's trading very much right in the range of its low. You then take a look on page 5 of the Euro stock. When you look at European stocks that continue to just look bearish, and each rally is failing, and we're on the verge of closing at a fresh new low on the Euro stock index. And then you take something like the Canadian TSX on page 6, also breaking to a lower low. The point here is that if this was a short squeeze, it's an incredibly pathetic one, and so far the bounce has been incredibly weak, and that to me is a bad sign. I mean, listen, if we see that some news catalyst come out and drive a move above 4,000 on the S&P, that may neutralize the short-term sell cycle and certainly kind of spur some buying reactions on the upside. But if the rallies continue in the next few days, or in the next few trading sessions, the way they did in the past few days, you have to consider this market still in a primary downtrend and highly vulnerable. And the one thing I wanted to just leave it with was on page 7, looking at the South Korean index, the KOSPI, and just in the last 2 weeks, we've just seen an extraordinary downdraft start, and it hasn't even bounced. It just continues to sell day after day. And so this is not about the U.S. markets. There is a global equity bear market underway, and there is broad selling right across the entire spectrum. And really, there is no reason to believe that at this moment, this is anything more than a short-term dead cat bounce. And I would remain hedged and defensive, and I wouldn't be overcommitting to the upside here. This is not, unless some sort of macro catalyst emerges that drives a trend change, you have to believe the path of least resistance is for all of these equity markets to continue to sell.
Now, Patrick, one of the most useful macro signals that we have is the U.S. dollar index. And as we've discussed at length in previous episodes of Macro Voices, the euro-U.S. dollar cross on page 8 is critical to that. Looks like we still are holding that previous low. We did not get a new lower low yet.
Well, exactly, but it's still actually holding its decade lows. And so while the US dollar has toyed with a breakout, it's really not confirmed unless the big heavyweight in the index, the euro, makes that breakdown. But again, look at the last 5 days of the euro reaction. I mean, we're just 100 pips right off of the lows. They haven't been able to muster up any reaction at all. This is an incredibly negative chart that continues to show active distribution in a downwards channel, and the bulls don't seem to have any enthusiasm to try to put together any sort of an upwards trend reversal. And so again, we're in a situation where if this little flagging formation rolls over into next week, we might find the euro heading down to parity, and that it could be the catalyst that drives the US dollar move. And if that happens, that could really be a signal that drives that risk off impulse in equity markets. I think watching this euro is actually one of the kind of best little canary in the coal mine kind of charts to watch going into next week.
And I'll make my own prediction here on dollar parity, Patrick. As much as institutional investors like to pretend that emotions are just for retail guys and they're immune to emotions, if we get to parity on the euro, I think that's a psychological holy shit moment that's going to cause a lot of people in the institutional world to change their thinking. But we'll wait and see what happens. Let's move on to crude oil futures on page 9.
Right, and what's interesting is that obviously the selling has really intensified. I mean, the sentiment was so decisively bullish in crude oil. Everyone was on that long side, and usually that means that there's leverage being used, and there's typical margin call sequences that happen that basically wash out those that were over leveraged or weak hands. The interesting part is we're now actually approaching some very critical levels. That green zone there reflects retracement zone from the rally off of March. So if this was just a correction and will prove to be a buy on dip, then on this August contract, those previous highs should act as support going into this pocket where we are, and we should see signs of oil reversing. Now, it's not necessarily a forecast, but it's an interesting level to watch into next week, because if we see that this was just a quick washout and the buy on dip traders come right back in, if we see prices next week back to 110 or higher and the charts turning back up, then this could have just proven to being a one great buy on dip in a primary uptrend. But you're right when you made the call saying that if there is a recession, that there could be more downside. But at this moment, this is a critical level to watch for a buy on dip, and I'm going to see whether or not it reacts off of here.
Well, I already bought this dip on this week's weakness, and I'm crossing my fingers that we're done here. But I've also made sure that my position sizing can tolerate another $10 down, because when we get the reality of recession and when the stock market turns from orderly sell-off to disorderly sell-off, it almost has to mean that crude oil futures get dragged down, at least temporarily. Longer term, though, I think we go much higher.
Eric, let's go to page 10 where I have the crack spreads, which is getting a lot of political press, obviously, in terms of gasoline prices and the profit margins. Obviously, we have seen actually decade highs in the Brent crack spreads, and it's really interesting to see that this trend has held up there. The bigger question is there the actual backdrop where these crack spreads can narrow again. Obviously, you have to hit demand in order to do so, and that recession could happen. But what a trend these crack spreads have had, right?
Well, Patrick, I want to be clear that I am not an expert on refining and the physical market, but from what I've learned about this in the last couple of weeks, it sounds to me like no. The answer is there is no room for crack spreads to come back down or refining margins to come back down, which is what the government is so concerned with. And it's really easy to see what's happened here. The critical thing to understand is that refineries are incredibly big, capital-intensive investments to build. If you want to have more refining capacity, you accomplish that by building new refineries. The payback, because of the massive size of that capital investment, is at least 10 years. So you've got to have a very strong argument that there's going to be payback for at least the next 10 or 15 years, or it just doesn't make any sense for any investor in their right mind to build any new refineries. Now, you then have President Biden take office and essentially declare war on the oil industry as if the oil industry is the enemy of the state. That means that nobody in their right mind would invest in new refineries and building them because this is a zombie industry that the government seems out to put out of business. Then all of a sudden, prices go through the roof, and particularly you see gasoline prices at higher levels for the same price of crude oil. And the government gets all upset and says it must be price gouging by these evil, nasty oil companies. No, what's going on is these oil companies are unable to build new refineries because President Biden's policies have made it essentially uninvestable to build new refineries. I think what this might come to at some point is the government might be forced to subsidize the construction of new refineries if private investors don't want to foot that bill. And of course, it would be next to impossible for Biden to sell that to his constituency based on the fool he's made of himself earlier in his term as president. So I don't see how he could possibly, have a government subsidized program to build new refineries. And thanks to his own policies, I don't see how the industry can justify building new refineries. That means we're stuck with the refining capacity that we've already got, and it's pretty clear that with the capacity that we've already got, well, look at the crack spreads and look at the price of gasoline. What's going to make this better is building new refineries, and there's no recipe for that to happen. But let's move over to junk bonds, Patrick. Now, I want to just qualify this to say you and I have both speculated, I don't know how many times in the history of MacroVoices, that surely, finally, these overpriced junk bonds are rolling over and it's time to short junk, only for us to find out that, no, the market surprised us and they moved higher. Are we finally seeing the big moment where junk is going to collapse?
Well, listen, all bonds collapsed, right? To me, it's all about the relative move. And what I found particularly interesting, like you saw on when we talked about the 10-year yield, how it has meaningfully retraced. And we're seeing, some of these very oversold bond conditions in Treasury have these reactions. But where we have not seen a reaction at all is after that huge breakdown in junk bonds, they remain very weak. And one of the big kind of the secondary canaries in the coal mine that is always a risk factor is when do the credit markets start to price in real credit risk for a lot of these lower tier companies that represent default risk. And what we have here is a junk bond market that's not only accelerated the breakdown here in the month of June, but the bounce has been a dead cat bounce. It's been very weak. And that is most easily reflected by looking on page 12, where we have the high yield credit spreads, and you can see them breaking to fresh highs now well above 5%, which is continuing to demonstrate some of the most immediate risks. And the fact that we are seeing credit spreads continue to blow out like this is a warning sign that the stock market is not very close to a bottom yet. Usually you see the credit spreads like this have their blow off and the credit markets calm down when you have a more meaningful bottom. The bigger question now is, will we see these credit spreads blow up to 10% or more before we ultimately see the bottom of this recession bear market? And that's certainly something that's going to be on my mind.
Well, I think it's very likely that they will, Patrick, and although you can't see it on this chart, it's not as if a 10% spread is unheard of. We've had that before. We've had higher than that before. And it seems to me
March 2020 was 10%, so it's not like it was within a year or 2 years that we had that, right?
And there were other times previous to that where we've had that and higher. So it's not like it can't double from here despite how far we've already moved on the high yield spreads. Now, listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. Details are on page 13, or you can just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what's in this week's Research Roundup.
This week, you're going to find the transcript for today's interview, as well as a link to the Darius' slide deck, as well as the charts we just discussed here in the postgame, as well as a link to a number of articles that we really found interesting. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. And for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow me on Twitter at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.